Hey everyone, and welcome right into this explainer. Today we're diving into something we're calling the edge of execution, decoding the universal trading blueprint. We are going to completely unpack the behavioral operating system that literally separates the consistently profitable operators from, well, the rest of the pack. As you'll see today, we're taking hard historical evidence from some of the most successful market participants in history and mapping it directly onto the modern micro-futures we trade today.
But right off the bat, I want you to picture a scenario. And honestly, this might hit a little close to home. You're staring at your screen. The trade is live. Suddenly, the price ticks against you. The heat of the moment kicks in, right? Pure fear and hope just grab the wheel. You start tweaking your exits, you're nudging your targets further out, hoping to squeeze out a couple extra ticks, you're sweating through completely normal pullbacks, or maybe panic closing early. Or even worse, you're stubbornly holding way past the plan you set when your head was actually clear. Look, we've all felt that visceral pain.
So the big question is, why do we do this? Seriously. Why do highly analytical, incredibly smart people universally sabotage their own accounts with the exact same emotional, mid-trade hesitation? Well, the reality is that human psychology is completely incompatible with the raw, unfiltered uncertainty of the market. Your brain is hardwired for physical survival, not for trading futures. Without a rock-solid framework, you are essentially just at the mercy of your own adrenaline.
Now take a look at these four absolute legends: Mark Minervini, Richard Dennis, Nicholas Darvis, and William O'Neill. Fun fact here, Darvis was literally a touring professional ballroom dancer, while Dennis was a mathematician. They traded in completely different eras, looking at entirely different instruments. And yet, here's the pattern interrupt. To break that pain loop we just talked about, they all independently arrived at the exact same conclusions. No gut feelings. They survived by relying on strict, uncompromising structure.
And that brings us to a concept we really need to put a name to: the universal behavioral principle. If you are out there constantly searching for that new holy grail secret indicator, let me save you a ton of time. The secret isn't an indicator at all. The secret is that every consistently profitable operator throughout history independently built the exact same mechanical system. Not to predict the market, because you can't, but simply to survive it.
So let's break down the shared universal DNA of that system. It really boils down to three punchy, undeniably effective pillars. Pillar 1, a purely mechanical entry confirmation. Pillar 2, a defined stop that you honor without exception. And Pillar 3, an emotionless mechanical exit. Let's dig into exactly how these legends applied these three pillars, starting right at the entry.
The crucial takeaway for Pillar 1 is that your entry absolutely must be mechanical and systematic. Complete elimination of guesswork. Nicholas Darvis literally drew physical boxes around price consolidation and bought the mechanical breakout above them, zero guessing. Richard Dennis famously turned $1,600 into $350 million using his turtle strategy. And amazingly, that started as a bet just to prove trading could be taught using purely mathematical rules. The second you remove that gut feeling from the entry, you've taken your first real step toward consistency.
Which leads us right into the second pillar, the defined stop. Take William O'Neill, for example. His research uncovered some incredible setups, but he held himself to a strict, unyielding 8% maximum stop loss. That was his invalidation threshold. If a trade hit that number, he was out. No bargaining, no hoping it would turn around. It honestly didn't matter what he felt the stock might do next. It was an objective line in the sand, honored every single time to protect his capital.
And finally, Pillar 3, mechanical exits. Think about it. Once you're actually in profit, how do you stop yourself from giving it all back? Mark Minervini uses this brilliant two-tier defense system, locking in partial profits at 2 to 3 times his initial risk. So even if it reverses, he's walking away net positive. Darvis used a trailing mechanism, constantly bumping his stop up just below the bottom of his newest established box. These trailing mechanisms are the ultimate defense. They create an exit strategy that completely yanks emotion and that brutal mid-trade hesitation right out of the equation.
Okay, so let's build a bridge here from those macro-historical lessons directly into the modern micro-futures arena. The timeframes we trade today might be way faster, but human psychology, yeah, that hasn't changed a bit. The macro rules used by Darvis and Dennis actually map perfectly onto modern micro frameworks, things like TRLC's accumulation, manipulation, distribution cycle, or the sneaky pivot strategy.
Seriously, think about it. When we look at how we validate modern microfutures, it's the exact same DNA. TRLC shows us how to mechanically identify a market bottom by waiting for the trap, that manipulation phase where retail stops are triggered, immediately absorbed, and followed by a structural shift. Or look at the sneaky pivot, which relies on a highly mechanical 15-minute 3-candle opening range breakout to validate an entry. These aren't brand new phenomena. They're just the modern expressions of those ancient trading truths.
But, and this is a big but, knowing a strategy isn't enough if your brain keeps sabotaging the execution. And that is exactly where Session Trading Lab, or STL, comes in. I need to be crystal clear about this. STL is not just another trading strategy competing with the sneaky pivot or TRLC. Not at all. It's the underlying behavioral operating system that makes those modern setups consistently executable. Basically, it's the software you need to install in your own head to run the strategy without breaking the rules.
To ground these big historical concepts into actionable steps for today's markets, the STL framework lays out incredibly strict mechanics. It uses a defined micro-future scaling plan where you scale out mechanically to lock in predictable momentum, very similar to Minervini's method. It also leans heavily on a thesis completion hierarchy, meaning you know precisely what the market has to do step by step to keep your thesis alive, and exactly what structural shift kills it. It completely removes the urge to bargain with the market mid-trade. Now, I want you to kind of fast forward your mindset for a second. Try to picture a totally new reality for yourself, one with actual peace of mind and consistency. Visualize yourself as this calm, defined operator. Your heart rate is steady. You are absolutely done sweating out pullbacks or frantically dragging your profit targets around. You are the future operator. You define your exact exit before you ever even click the mouse to enter, and you honor it mechanically every single time.
For so long, traders have looked at rules like they're a straitjacket, like they're a constraint holding them back from catching that one massive home run trade based on a hunch. But history's greatest operators have proven the exact opposite is true. So I'm going to leave you with this paradigm-shifting thought. The rules were never the constraint. The rules were always the edge. Session Trading Lab. So the next time you sit down at the charts, ask yourself, are your rules currently holding you back, or are you finally ready to make them your edge? Thanks so much for joining me on this explainer, and I'll see you on the next one.